What's up everybody, Nate here, and today I want to briefly go over the Federal Reserve and their plan to fight inflation and how they might go for a hard U-turn sometime very soon. Now, the reason that they're going to go for a hard U-turn is because they've gotten so aggressive over the last few months with their monetary policy. Federal Reserve's Daily has said that they do not plan to go on a U-turn, but Federal Reserve Chairman basically noted that this might be possible in their next September meeting. Now, the whole reason that the Federal Reserve might see a U-turn sometime soon is because, well, their plan to fight inflation is actually working, but it might be working just a little bit too well. So let's kind of break things down. The reason the Federal Reserve might go on a massive U-turn of its monetary policy and its interest rates is because of jobs. Jobs in the United States are really strong, meaning that unemployment is still very low in the United States, at a record low right now. But here is the thing, job postings for June 2022 actually decreased. So we're starting to see businesses pull back on a lot of their hiring, and we also saw layoffs and a little bit of unemployment actually spike from a lot of different companies. Now, this has everything to do with the Federal Reserve because the Federal Reserve is raising its interest rates. The Federal Reserve can do two things when it comes to its monetary policy. It can print a whole bunch of money and raise its interest rates, or it can hold back its printing and, well, stop its interest rates. So it can lower its interest rates, and that will bring a lot of demand into the economy. That's what it did over the last 2 years because there were so many economic uncertainties all throughout the country, and the pandemic was raging in the United States. Now, though, in 2022, they are raising their interest rates because all that demand caused really high inflation for all goods and services. But that is a really good thing for the Federal Reserve and our economy. So job postings going down actually means that the Federal Reserve's rate hikes are actually starting to work. When they raise their interest rates, that means that demand for everything is going to start coming down. The theory kind of goes like this. As the Federal Reserve raises its interest rates, that means there's going to be a whole lot less businesses that are formed because it's going to be hard to form a business when interest rates are really high. People are not going to be able to qualify for a loan because interest rates are so high, so they're not going to do it. The same thing can be said for investments and businesses in general trying to take on debt in order to grow. All of that makes businesses not able to grow as quickly, and if businesses can't grow as quickly, they're not going to be able to hire as many people, and they might have to start cutting people in order to make profits in 2022. All of that creates a situation that is basically the opposite of what we've seen over the last 2 years. Our labor market has been really strong. People looking for jobs have had all of the power. That's something that has fueled the Great Resignation. Millions of Americans were job hopping, and they were getting better benefits, they were getting better work-life balance, and of course they were getting better pay. All of that is basically going away in 2022 because our labor market is becoming very tight by the Federal Reserve. Essentially because a lot of people aren't investing in businesses, these businesses are pulling back, and because inflation is so high, sales are not as strong for these companies either. They don't have as much money, which means the labor market is getting tighter because jobs are disappearing, and they're not looking for as many people because they can't afford to pay them all. When you have a really tight labor market, that means people are now going to be forced to kind of take jobs that they don't really want for a lot less pay and benefits and work-life balance. All of the things that we've seen from the Great Resignation are going to start disappearing because the labor market is getting tighter. Job postings are going down, and if that continues, that means the Federal Reserve's plan is starting to work. The other thing that the Federal Reserve is looking at right now is, of course, the benchmark inflation numbers. In July 2022, inflation hit an over 40-year high of around 9.1%. That is extremely high, and that means that the Federal Reserve has to get really aggressive on its monetary policies. But a lot of experts and investors are predicting that inflation is going to cool off for the month of August, and the main reason for that is because energy prices are going down, and energy comprises around a third of the consumer price index, the report that we use to measure inflation on a month-over-month basis. But this is not the entire story, as we're still probably going to see food prices and housing prices and a lot of other prices go up all throughout the United States. It's just that one factor that's bringing inflation down, and it's probably only going to be temporary. Like I said before, as this labor market gets really tight, businesses are now going to be forcing people back into the office because employees don't really have the choice to go to a new job anymore. That means that inflation is probably going to go back up as more people rely on gas in order to fuel their cars and go to work. And we know the Federal Reserve's plan is working because we're starting to see those job postings decrease, but not enough to where the Federal Reserve is completely completely stopping its interest rate hikes at this point. There are still 1.8 jobs available for every unemployed person in the United States. That means that the jobs market is still too strong for the Federal Reserve, and they need to start stepping in a little bit more and raising their interest rates. But there is more that can happen than just the business side. This is going to affect a lot of Americans, because if Americans can't get a job or they're pushed out of their job, well, then unemployment is going to increase and Americans are not going to be able to buy anything in 2022. Looking forward, in September, the Federal Reserve might only raise its interest rates by around 50 basis points. Now, this is conflicting because a lot of experts and investors have said 50, 75, or a full basis point hike is on the table for their next FOMC meeting in September. The reason they might start slowing down, though, is because they're starting to see some signs that their plan is actually working. But the problem is, right now is a tipping point for the Federal Reserve. The federal funds rate sits at around 2.25 to 2.5%, and that is considered a neutral level for the Federal Reserve and monetary policy. It's not going to grow your economy, but it's not going to drastically hurt it either. Wall Street loves that because they know the Federal Reserve is going to sit here for the next month or so. That's why you've seen a lot of gains recently on the New York Stock Exchange, and we don't have as many earnings reports coming out after this week. So everything is going to be basically neutral and the stock market is going to go back up. But this is one big fake out from inflation and the Federal Reserve, and something that you need to keep an eye on. At the end of July, we got the Q2 2022 numbers for our GDP, and it showed that GDP actually shrank by 0.9%. In Q1 of 2022, GDP shrank as well, so it went down by over 1%. 2 consecutive quarters of economic shrinking means that you are technically in a recession. Now, I will say we are not in an official recession as of yet, but this is something that the Federal Reserve has to keep an eye on, and something that you have to keep an eye on, because if the Federal Reserve continues to raise their interest rates, if they continue to fight inflation while we are in a recession, that is going to be very bad for you. Like I said before, the Federal Reserve can only do so much. So they can spark demand by printing money and lowering their interest rates, or they can pull a lot of that demand back, because this affects more than just businesses. Regular everyday Americans are not going to be able to go out and get a mortgage if interest rates continue to go up, and they have gone up to 5, 6, and 7% on average for a 30-year fixed mortgage all throughout the United States over the last couple of months. That bars millions of people from getting a mortgage, and the same thing is happening to credit card spenders and people that want an auto loan. That means that demand is coming down and there's just less spending overall. But the Federal Reserve can only do those 2 things, and a lot of our inflation problems are being caused by, well, not those 2 things. I will say the Federal Reserve printed a ton of money over the last 2 years, and by definition, that's what inflation is. The monetary supply of a country is going up, meaning that there is a lot more dollars out there, and that sparks demand. However, we saw a lot of pandemic pressures like supply chain breakdowns and, of course, wars overseas that are starting to bring prices for just about everything way up throughout not just the US, but the entire world. That creates a really bad problem for the Federal Reserve and our economy, because if the Fed wants to continue to fight inflation, well, that means they're going to have to continue to raise interest rates, all at a time when inflation really isn't going to come down that dramatically, because a lot of the problems that we're facing are because of issues outside of the United States. This is why the Federal Reserve might go into a complete U-turn with their monetary policy, because if they continue to raise their interest rates, well, that's going to mean that Americans are getting hit from both sides. Prices are still probably going to go up, and of course, that's not really going to help when the Federal Reserve is also raising interest rates, so Americans can't spend on a credit card because those come with an adjustable rate interest rate. All of that debt is just going to get more expensive. Can't buy a house, you can't buy a car, and grocery bills are also going up, or at least staying the same. That is just going to hurt demand even more, so the Federal Reserve might see that and start to cut their interest rates or drastically slow down their monetary policy with their interest rate hikes in 2022 or in 2023. They might have to, because our economy might end up going into a deep recession if they continue to raise their rates while all of these other global problems are going on. The only way the Federal Reserve is going to have an impact on inflation at this point is if they continue to raise their interest rates so aggressively and so high that, well, there is just no more economic demand in our economy at all. I mean, spending simply can't survive. People are not going to be able to afford anything in the realm of loans, and that means that nothing is going to get spent at all, meaning that demand just naturally starts to come down. But that's also going to be followed by huge unemployment and layoffs and probably some businesses disappearing. And the Federal Reserve and the federal government doesn't want to see that either, because that basically means that you are in a recession. So the Federal Reserve is trying to avoid that by really playing their interest rate policy very tight, and that means they might slow down in September, raising their interest rates by only a 0.5 percentage point, because they don't want to see the economy go into a deep recession and them be the reason for that. That's why I think that they're going to take this very slowly, and they're going to kind of see how the economy looks a month from now. There is a huge benefit to that because they don't have to do much over the next month or so. So this is going to be a huge turning point for the Federal Reserve, and no matter what they do next, there is no turning back, and they're either going to turn around and start going a lot slower or cutting interest rates altogether, or they're going to push forward, because if they push forward and in 2023 or late 2023 they start cutting interest rates at that point, well, this is going to be a bad situation for the US dollar and our economy. But if they start doing things a little too aggressively right now, well, that's really bad too, because that could send us into a recession immediately. But now I want to hear from you on this issue. What do you think about the Federal Reserve essentially making a huge U-turn on their monetary policy? Do you think this is something that is coming in the near future, or do you think the Federal Reserve is going to push ahead and continue to raise their interest rates until inflation has disappeared? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.